Hello dear traders! All three main stock indices closed the previous week with a rise, thus marking their sixth week of gains. On Friday, the indices closed with a 0.4%, while the S&P reached a new yearly high amid optimistic macroeconomic reports, which raised hope for a soft landing. Fresh data reduces the likelihood that the Fed will start loosening its monetary policy in the spring of 2024. The new week will be very important for investors and could be the main period of the outgoing year. Although that will happen in the next few days may determine the market situation in 2024. Traders are likely to focus on the consumer price index, producer price index, and retail sales. The FOMC meeting is also scheduled for this week. Stay tuned, the financial market is always rich in unexpected and interesting events. Watch the video till the end and share your opinion in the comments. On Wednesday, the Federal Reserve will hold its last meeting this year. According to the forecast, the results of the meeting will hardly surprise investors as monetary policy is expected to remain the same. The Fed is unlikely to alter its rhetoric. That's why traders should not expect any signals of a switch toward gradual loosening. On Tuesday, the United States will issue its last inflation report this year. Although inflation is likely to go on falling, the pace may slacken. Thus, inflation may drop to 3.1% from 3.2%. Notably, core inflation may accelerate in November. The producer price index may show a mixed dynamic. In recent months, it has been rising more often than falling. According to the forecasts, producer price inflation may climb to 0.1% in November. These facts confirm the Fed's idea that inflation slackening is not stable at the moment. The regulator may keep the key rate at the current level for a long period amid considerable economic growth, a reasonable unemployment rate, and the needed number of new jobs in the non-farm sector. Nevertheless, the Wall Street rally reflects that traders have their own views on the situation. Investors became less active ahead of the important events. On Monday, futures on the US stock indices each down. Notably, speculators almost fully priced in the key interest rate hike at the upcoming meeting. However, some investors remain cautious about various signs of the key rate cut in 2024. If the U.S. inflation figures exceed expectations and the Fed's comments are more dovish than usual, this week will be very eventful for Wall Street. The Dow Jones closed the previous week with a slight increase. It seems that the index was trading near the highs it reached thanks to its rally in November. In other words, it entered a consolidation phase. This could be followed by either a jump to a new high or, which is more likely, by a slower rise. This week could indicate future trends. Investors are likely to clear up the situation, make conclusions, and understand what they may face next year. This, in turn, will shape a futures movement. Most U.S. analysts suppose that the rally will continue in 2024 thanks to monetary policy loosening. Even if Jerome Powell changes his mind, markets will hardly accept reality without a key rate cut. In the worst-case scenario, the market will see a downward correction at the end of the year. In general, the uptrend will remain intact. Traders may pay close attention to Powell's words as economists are demanding more accurate information about the key rate cut. Jerome Powell, who actively supports a cautious approach, is expected to provide the regulator with a kind of freedom in making future decisions. Meanwhile, he may repeat that monetary policy will remain unchanged for some time to restore price stability. The S&P 500 reached a new peak above 4,600 points, thus meeting all the expectations for this year. At the end of the previous week, market volatility was high amid the publication of employment figures. At first, indices dropped, but by the end of the trading day, they exceeded yearly highs. The last time the S&P jumped to 4,607 points was this summer. On Friday, the index climbed to 4,609 points. Curiously, to return to its highest levels, the market needed just 6 weeks. The index has rallied by more than 12% from the levels recorded in October. From a technical point of view, the stock bulls are successfully reaching their goals. According to the main forecast, the S&P should have increased to new highs. Even overbought conditions and divergence failed to prevent the upward cycle. The main changes affected the fundamentals of the formation of the exchange rate. A decrease in the cost of funding contributed to an increase in the value of business on the stock exchange by reducing discount rates. Despite the possible desire of some investors to lock in profits from long-term positions, the very fact of updating price peaks is a powerful signal reflecting great interest in risky assets. Therefore, there is a high probability that the S&P will continue to move to an absolute high from January 2022, approaching 4,800. For reference, this event is likely to take place in the spring of 2024. Notably, this round of growth may coincide with the beginning of lowering rates in the United States. According to the latest Bloomberg survey, the S&P will exceed the level of 4,800 points next year as the US avoids plunging into recession. However, weakening consumer activity may force the index to show a minor growth. The Nasdaq lacked less than 0.2% to reach its highs in December. This will hardly be challenging for such a highly volatile instrument, especially amid solid reasons. The market estimates an almost 50% probability of a quarter percentage point rate cut in May after the publication of employment figures last week. The report unveiled a slow increase in core prices in the US. The likelihood of a rate cut at the Fed's meeting in March is slightly less than 43% compared with 53% the previous week. Citing more favorable inflation news, Goldman Sachs analysts revised their forecast for the first two rate cuts in 2024. Now they suppose that it will take place in the third quarter. Earlier, it was said that the first rate cut would occur in December of next year. As for corporate news, investors will keep an eye on the quarterly reports of such companies as Oracle Corporation, Adobe Systems Incorporated, and Linear Corporation. On Monday, Cigna's shares showed a rise that exceeded 16%. The American insurance company has stopped negotiations on the possible acquisitions of its Humana counterpart. The rejection of negotiations occurred at a time when Cigna, based in Connecticut, announced its intention to repurchase its own shares for $10 billion. The chairman of the board of directors stated that the company's shares were significantly undervalued, and the buyback was a measure that contributed to the growth of the cost of capital. And we continue to monitor the stock market situation to keep you abreast of the latest events. Subscribe to our channel and leave comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.